Hi, Rohan Taylor from Blackburne Finance and Investments. One of the directors here at Blackburne, and we see a lot of people come through our doors and we ask them the same question. How come you're tipping the tax man? And they go, what do you mean? And we have a look at their position and we realise there's a whole lot of costs that they could have claimed that they haven't. So today we're going to let you know about our top 8 items that people don't claim that they really should. The first one is borrowing costs on your loans. Now, if you've borrowed money from a bank for investment purposes, the establishment costs, legal costs, valuation costs, they're all tax deductible. Now, they're tax deductible over the life of the loan or 5 years, whichever is shortest. Usually, it's the 5 years. Doesn't sound like much, but it does add up. The second one is income protection insurance. Now, a lot of people have income protection insurance, but they don't realise that it's actually tax deductible. Temporary permanent disablement insurance, life insurance, they're not actually tax deductible, but income insurance is. And it can make the difference between you keeping such an important policy in place or giving it the boot with the gym membership when you start doing the budget figures. Number 3, depreciation on investment properties. Now, any property that was bought after July 1985, you can claim the loss in value of the actual building. So if it cost $100,000 to get that building with a roof on, windows in, doors, then you can claim 2.5% of that figure, the $100,000, every year for 40 years. $2,500 coming straight back to you is a fantastic outcome. The second side with depreciation is things lose value. So if you bought carpet for $1,000 today, in 5 years' time, and you tried to sell it on Gumtree, then someone might give you $200 for it because it's wearing out. Now the government lets you claim that loss, that $800 difference in value. And that's on carpets, doorknobs, fire extinguishers, garage motors, swimming pool motors, curtains, ovens, the whole lot. The best way to maximise those deductions is to get a depreciation expert in. Okay. They'll give you a report that tells you everything you can claim, because usually people underclaim the amount of depreciation that's legally entitled to them and they end up tipping the tax man, and we don't want to do that. So make sure you get that side of it professionally assessed. Number 4, ongoing investment advice. Now, once you've seen your financial planner or your accountant, anything after that, whether you pick up the phone, the cost of the phone call, send them the letter, the cost of sending the letter is all tax deductible. If you go to an investment seminar, that's tax deductible as well. Again, these are little costs, but if you're really active with your financial planner or your accountant, it does add up and it can actually offset a lot of the cost of the advice that they give you. So make sure you keep a record of it and keep those dollars in your back pocket. Item number 5 is low value pool depreciation. So we touched on depreciation before. So if you have an item that's worth $300 or less, the government and the Australian Tax Office says you can claim the full write-off for that item in that year, which is great, especially around when you have replacement items and those lower cost items. So keep a record of those particular items that are $300 or less. Also, if you're in a group building, apartments or townhouses, and you have something replaced on the common property, let's say it is that garage door motor, then you share in the cost of that motor. So if it's $1,000 and there's 10 of you in the building, your share of that cost is $100. That falls into the low value pool, which means you can claim the full $100 in depreciation in that financial year. Fantastic. Okay, number 6. Now, if you're renovating your investment property, before you get the sledgehammer out and take to the bathroom or take to the kitchen, get an expert in to assess the amount of depreciation that is left on the items you're about to throw to the tip. Because once you pull all those items out, you can claim the remaining value of those actual items in that year. So for example, if you're pulling the kitchen out, then there might be depreciation left on the oven, on the range hood, on the cooktop, all the other bits and pieces, door handles, so you can claim them. Okay. Now, important to note, if you're doing renovations on an investment property and you're replacing a kitchen to bring it back to the original standard, that is a deduction that you can claim in that financial year. If you decide that you'd like to have stone tops and new overhead cupboards that weren't in there before and just upgrade it to try and get more rent, that's called a capital cost, and you can't actually claim those items until you sell the property. So be really mindful of that one, because a lot of people do get caught out. Number 7, vehicle expenses. Now, we're amazed at how many of our clients come in and they're asked to pop down here or they pop down there, do a trip here, all asked by their work, but they're not claiming the costs. Now people say, I don't want to keep a logbook. Well, there's other ways to claim those expenses without using a logbook. So if you are being asked to do things for work, then mention it to your accountant. Things like the cost of maintaining the car, fuel, registration fees, all of those bits and pieces, you can get some money back. Now again, that's not going to be a huge amount, but it's much better to have the money in your back pocket than in the tax man. Well, that's what I think anyway. Number 8, private health insurance. Now, a few years ago, the federal government played around with the 30% rebate, and they said, well, if you're earning any more than $84,000 as a single or $168,000 as a couple, then we're going to slowly take away that 30% rebate. So if you're thinking next financial year, 2014-2015 financial year, that you might be earning more than what you are this year and it's going to affect your rebate, then you can prepay an entire year's premiums now, before June 30, get the tax deduction and the full rebate in place around that particular insurance. They're our top 8 of all of the items that we find clients come through and they're tipping the tax man. So if you'd like some help with a great accountant, please give me a call and we can put you in touch. We have some great depreciation experts we can refer you to, and when it comes to property and understanding keeping money in your back pocket, at Blackburn we've been doing that for over 40 years. So feel free to give me a call at Blackburn on 1300 Invest, or go to our website blackburninvest.com.au. I'm Rohan Taylor, Director of Financial Services here at Blackburn.